Ever heard of a company going rogue, making headlines for shady practices, and leaving investors fuming? That's what happens when corporate governance goes south. But before you switch off, thinking this is just another snoozefest about suits and boardrooms, hear me out. Trust me, it's way more interesting than you might think. This is your one-stop shop for understanding everything corporate governance. We'll break down the basics, what it is, who the key players are, and why it matters. We'll also explore the principles that make good governance good, the challenges companies face in implementing it, and even some hot-button trends shaping the future. So get ready, whether you're a business buff, a curious investor, or someone who wants to understand what's happening in the corporate world. This ride is about to get informative. Let's kick things off by answering the burning question, what is corporate governance? At its core, corporate governance refers to the framework of rules, practices, and processes by which a company is directed and controlled. It's like the blueprint that outlines how a company operates, encompassing everything from stakeholder relationships to risk management. Think of it as a balancing act between different interests, shareholders, management, employees, customers, suppliers, and even the community. The primary goal: to ensure transparency, accountability, fairness, and ethical behavior in all aspects of the organization's operations. In a nutshell, it's all about creating a structure that maximizes shareholder value while promoting sustainable growth. Now, let's talk about the key players in corporate governance. Picture a team of superheroes, each with their own unique powers and responsibilities. First up, we have the CEO, the Chief Executive Officer. They're the highest-ranking executive, responsible for the overall management and operations of the company. The CEO sets the organization's vision, goals, and culture, leading the management team to execute strategies that align with the company's mission. They also represent the company externally, building relationships with stakeholders and industry partners. Next, we have the board of directors. This diverse group holds ultimate responsibility for corporate governance. Comprised of executives, independent directors, and sometimes representatives of shareholders, the board oversees management and safeguards shareholders' interests. They set the company's strategic direction, approve major decisions, and monitor performance against objectives. It's a big job, and they take it seriously, appointing and evaluating the CEO, approving executive compensation, and ensuring compliance with legal and regulatory requirements. Then there's the Audit Committee, a subcommittee of the board that focuses on financial reporting and internal controls. Made up of independent directors with financial expertise, the Audit Committee ensures the integrity and accuracy of the company's financial statements. They review financial reports, assess internal controls, and oversee the external audit process. Their work enhances transparency and builds investor confidence in the company's financial reporting. Now, let's not forget about managers. These senior executives are responsible for executing the company's strategies and achieving its objectives. They lead various departments, such as operations, finance, marketing, and human resources. Managers are crucial in implementing corporate policies and managing resources effectively, ensuring that everyone is aligned with the company's goals. Lastly, we have the other stakeholders. This group includes customers, suppliers, financiers, government entities, and the community. Each of these stakeholders has its own interests and expectations. Customers want quality products and services. Suppliers seek fair relationships. Financiers expect returns on their investment, and communities look for companies to contribute positively to their local economies and environments. Corporate governance involves engaging and managing relationships with these diverse stakeholders to create a positive impact. Now that we've met the key players, let's dive into the procedures for making corporate decisions. Corporate decision-making is critical to governance, shaping a company's direction and outcomes. The board of directors typically serves as the primary decision-maker, with procedures outlined in governing documents like bylaws and charters. Board meetings are where the magic happens. Directors gather to discuss and vote on important matters, reviewing reports and presentations from management and committees. Discussions cover everything from strategic planning to financial performance. Decisions are made through majority votes, and minutes are recorded to ensure transparency and accountability. But not all decisions require a formal meeting. Boards can also make decisions through written resolutions, allowing for timely decision-making on urgent matters without convening physically. It's a flexible approach that helps keep things moving. Delegation of authority is another key aspect of decision-making. Boards may delegate certain powers to committees or management teams to streamline operations and leverage specialized expertise. This allows for more efficient decision-making while ensuring that the board's objectives and values are upheld. Strategic planning is where the long-term vision comes into play. Boards engage in discussions to assess market trends, competitive dynamics, and stakeholder expectations to identify opportunities and risks. It's a collaborative effort that involves setting objectives and allocating resources to achieve them. Risk management is integral to informed decision-making. Boards oversee the identification, assessment, and mitigation of risks to protect the organization from potential threats. This proactive approach helps companies capitalize on opportunities while safeguarding their assets. Now, let's not forget about compliance and ethics. Boards uphold high standards of corporate governance to maintain integrity and trust. Decisions related to compliance with laws and ethical principles are paramount in mitigating legal and reputational risks. Establishing codes of conduct and implementing whistleblower mechanisms are just a couple of ways boards promote ethical behavior. Lastly, stakeholder engagement is crucial. Effective decision-making involves engaging with various stakeholders to understand their perspectives and concerns. Gathering feedback through surveys and dialogue sessions helps inform decisions related to corporate social responsibility and sustainability initiatives. So, why is strong corporate governance so important? The benefits are multifaceted and far-reaching. First and foremost, strong corporate governance enhances transparency and accountability. By ensuring companies disclose accurate and timely information, stakeholders can make informed decisions and hold management accountable. This builds trust and confidence in the organization's integrity. Effective governance also mitigates risks and safeguards assets. By overseeing risk management processes, boards protect the organization's financial stability and reputation. This proactive approach helps companies become more resilient, ultimately benefiting investors and other stakeholders. Strong corporate governance improves decision-making and performance. By promoting sound decision-making processes, boards provide strategic guidance and oversight to management teams. This results in better resource allocation and performance monitoring, driving operational excellence. Moreover, strong corporate governance fosters investor confidence and access to capital. Companies with robust governance practices attract and retain investors who seek assurance of responsible stewardship. This, in turn, enhances corporate reputation and reduces the cost of capital. Let's not forget about long-term value creation. Corporate governance promotes a culture that balances the interests of various stakeholders, contributing to sustainable growth. When companies engage with stakeholders and operate ethically, they build trust and loyalty, supporting long-term success. Attracting and retaining talent is another key benefit of strong corporate governance. Companies that prioritize ethical leadership and a supportive work environment appeal to skilled professionals seeking meaningful careers. This contributes to overall workforce effectiveness and engagement. Succession planning and leadership development are also crucial. Governance frameworks ensure continuity in executive leadership transition, reducing disruption and enhancing organizational stability. This instills confidence among stakeholders in the company's long-term viability. Finally, strong corporate governance enhances corporate reputation and brand value. Companies that demonstrate ethical conduct and social responsibility earn the trust of customers, suppliers, and the broader community. The positive reputation drives customer loyalty and market credibility, ultimately leading to revenue growth. Now that we understand the importance of strong corporate governance, let's explore the key principles that guide effective governance. Transparency is the first principle. It's all about being open and upfront about how a company operates and makes decisions. Transparent companies share accurate and timely information, allowing stakeholders to see what's happening behind the scenes. Fairness is another crucial principle. It entails treating all stakeholders with equity and respect. Fair governance practices ensure that decisions are made objectively, without favoritism, and that the benefits and burdens of corporate activities are distributed fairly. Accountability is essential in corporate governance. It's the obligation of individuals and entities to take responsibility for their action and decisions. Directors, executives, and employees must act in the best interests of the company and its stakeholders, with mechanisms in place to ensure accountability. Risk management is also a key principle. It involves identifying, assessing, and mitigating risks that may affect the organization's objectives. Effective risk management is crucial for protecting the company from potential threats while capitalizing on opportunities. Responsibility in corporate governance refers to the ethical obligation to act ethically and lawfully. This includes considering the broader impact of business decisions on stakeholders and the environment. Responsible governance practices prioritize corporate social responsibility and sustainability. Awareness is another important principle. It's about understanding the evolving internal and external factors that may impact the organization. Staying informed about industry trends and regulatory changes enables companies to make informed decisions and remain competitive. Integrity is the foundation of ethical conduct in corporate governance. It involves adherence to moral and ethical principles, honesty, and consistency in actions. Upholding integrity means avoiding conflicts of interest and maintaining confidentiality when required. Lastly, adaptability is crucial. Organizations must be able to respond effectively to changes in the business environment. Boards and management teams should remain agile and proactive in anticipating trends and adjusting governance practices accordingly. However, implementing good governance is not without its challenges. Resistance to change is a significant hurdle. Established practices and cultural norms may impede efforts to introduce new governance structures. Overcoming this resistance requires fostering a culture of openness and communication, engaging stakeholders early in the process, and demonstrating the tangible benefits of governance reforms. Complexity and overregulation pose another challenge. Navigating the maze of regulatory requirements can be overwhelming, especially for smaller companies. A risk-based approach to governance can help organizations prioritize material risks and streamline compliance processes. Lack of resources and expertise is also a barrier. Many organizations, particularly smaller ones, may struggle to invest in governance initiatives. Prioritizing governance investments based on risk exposure and leveraging external expertise can help address these constraints. Board diversity and independence are crucial for effective governance, yet many organizations face challenges in this area. Promoting diversity and independence within the boardroom can enhance decision-making processes and mitigate conflicts of interest. Cultural and ethical challenges can undermine governance efforts. Fostering a values-driven culture that prioritizes integrity and ethical conduct is essential for overcoming these challenges. Leadership commitment to ethical behavior and implementing codes of conduct can reinforce ethical norms within the organization. So, how can organizations implement effective corporate governance? It starts with assessing current governance practices. Understanding strengths and weaknesses is crucial for identifying areas for improvement. Next, define governance objectives and principles that reflect the organization's values and strategic priorities. Establish governance structures and processes that facilitate effective decision-making and oversight. Develop comprehensive policies and procedures to govern corporate behavior and operations. Enhance risk management practices by integrating them into governance processes. Promote stakeholder engagement and communication to build trust and transparency. Monitor and evaluate governance effectiveness through regular assessments and stakeholder feedback. Finally, foster a culture of continuous improvement and adaptability to stay aligned with evolving expectations. As we look to the future, several current trends are shaping corporate governance. There is a growing emphasis on environmental, social, and governance factors, with companies increasingly integrating sustainability into their practices. Board diversity and inclusion are also gaining traction as organizations recognize the value of diverse perspectives in decision-making. Shareholder activism is on the rise, with investors advocating for corporate governance reforms and social responsibility. Digital transformation and cybersecurity governance are becoming integral to corporate governance as companies navigate the digital landscape. The shift to remote work has prompted organizations to reevaluate their governance structures, while stakeholder capitalism is gaining recognition as companies prioritize the interests of all stakeholders alongside shareholder value. Regulatory reforms continue to evolve, challenging organizations to navigate complex legal frameworks. In conclusion, corporate governance may seem complex, but it plays a vital role in shaping the success and integrity of companies. By understanding the key players, principles, and challenges, we can appreciate the intricacies of making sound decisions in today's fast-paced business environment. Remember, good governance isn't just about following the rules, it's about fostering an environment of transparency, accountability, and ethical conduct that benefits everyone, from shareholders to the community. So, let's champion good governance and drive positive change in the corporate world.